Welcome unit holders of ESR-REIT and ARA LOGOS to the SIAS Fireside Chat featuring ESR-REIT and ARA LOGOS. Today we have the honor of featuring Adrian Chui, the CEO of ESR-REIT, and we have Karen Lee, the CEO of ARA LOGOS, to join us on this Fireside Chat today to talk about the merger between the two REITs. Now, just a bit of background on today's Fireside Chat. It's all about scale. It's all about the new economy, and it's all about making things bigger and better for unit holders. And we have lots of questions that we're going to pose to the two CEOs today. But let me set you the background of today's chat before we go into the questions. Now, we've always said that the size does matter, and in many cases, REITs have been merged in the past to gain size, to gain advantage in the marketplace. But REIT holders are asking both CEOs today, why now? Why at this moment when the market is soft, when the new economy is still growing? Why now in terms of the merger situation? And also, does the merger between the ESR Cayman and also ARA management, does that have anything to do with this merger? So with that as a background, let me then pose the questions to the two CEOs this morning. Give us a background on the deal.
Thank you everyone for joining us. For us, in the REIT sector, we've always articulated that size does matters. In fact, we are the opinion that right now that size increasingly matters. The most compelling reason why we believe that this merger actually is beneficial to our unit holders is that there has been a paradigm shift in our economic lives, which actually presents a great opportunity for us. This paradigm shift is based on how we produce, how we consume, and how we deliver goods and services. And this has been driven by technology as well as e-commerce. And this has started way before COVID pandemic has arisen. Now the COVID-19 endemic now, has just hastened this shift paradigm shift at a faster pace. And that is why we believe that the merger, when we can do a merger and there is size, ESR-REIT and ALOG are actually well positioned to take advantage of this disruption in the overall economic activities. Our portfolio of logistics assets as well as high-specs assets, which are actually suitable for data center operators and advanced manufacturers, are well positioned to take advantage of this demand for this, what we term new economy assets. Now, not only that, investors have also taken notice of this paradigm shift, and they are now reallocating their capital and their money to these new economy assets. Increasingly, they are also allocating their money into fewer managers, but sizable ones. Now, as two separate REITs, ESR-REIT and ALOG, we are actually considered mid-cap REITs. And because of this, our ability to attract large capital inflows is quite limited. But this merger actually allows the enlarged REIT, which is going to be called ESR-LOGOS REIT, to actually take advantage of this unique opportunity of new demand, sustainable demand for new economy assets, as well as at the same time tap onto the larger capital inflows that's coming into this sector.
Thanks very much, Adrian, for that in-depth insights into why size matters in the new economy. Maybe Karen, we can hear from you. What's your perspective on size and scale?
The value of creation of an enlarged REIT actually goes beyond the DPU accretion to both sets of unit holders. Investors are increasingly allocating larger amount of capital to managers with a large asset portfolio. So we want to be there to take advantage of this situation. And a 5.4 billion AUM ELOG post-merger will definitely be on the radar of these investors. And with a larger platform, ELOG will be able to acquire more sizable transactions and also do it faster, especially if the assets, if the new economy assets which are highly in demand are fairly competitive in the investment world now. So hence, I believe that this merger is actually a transformational one. not just helping us to grow in terms of size, but it will actually transform the fundamentals of both REITs and turning us into a new economy, benchmark new economy APAC S-REIT moving forward.
Maybe I add also is when we say size does matter, it's just not for the REIT. It's also for the capital and investor providers as well. They also want to see size matters to them. So it's both sides.
So with that, you have the size to get invited to the new economy party. You have the size, you have the capability, and you're going to be in the top 10 REIT in Singapore. What can they look forward to in terms of your ability to compete better in the marketplace beyond the size?
The sponsor ESR Cayman has actually a strong footprint in various countries. So for the enlarged REIT itself, moving forward, we will be focusing in our base market, which is Singapore, Australia. And likely we will look beyond that, looking at Japan and China as well. Post-merger, the key question is, how quickly we can execute all our strategies. And both Adrian and myself, we are confident with our experience, track record and the sponsor support, we can quickly execute these strategies that we have been articulating to our unit holders.
So 50 billion in pipeline from the sponsor ESR Cayman?
Yes, but this 50 billion is over different jurisdictions and have different countries, I would say, and also different stages of their so-called life. Some are about to be completed, some are under leasing. But what is important, out of this 50 billion, there is a very visible and executable pipeline of 2 billion in the short term that we can look at, and this is what really excites.
Don't forget that we should mention, there's this 10 billion development pipeline in
yes,
progress.
Exactly.
So actually, the pipeline that we have is even much larger.
So you got scale, you're in the right sector,
Yes.
There's a tailwind, there's a big new economy wave, great pipeline from the sponsor. If there was one word that you'd like to share with investors, Adrian and Karen, what would be that one word be to excite them about this potential merger between ESR-REIT and ALOG?
Size increasingly matters. You are not sizable, you are not in the right sector, you can be quite easily taken over or in a way forgotten in that sense, because our economic life has changed. So the way we produce goods, the way we deliver goods, the way we consume goods is going to put a very high demand in such new economy assets. And this is where these new economy assets, logistics assets, high-specs assets, high-specs properties that's suitable for data center operators and all, actually it's going to be sustainable demand. This is not a property cycle. This is really a change in the way the demand for real estate assets are going to affect us.
And Karen, can we hear from you? What would be that one word or one phrase that would summarize all this excitement for the merger?
I would say that this is a transformational merger for both REITs. So with this merger itself, what's transformed is that it immediately puts us within the top 10 S-REITs by free float. And by doing so, we are already in that top 10 league with the other major REITs as well. And becoming a larger platform, we could potentially lead this REIT to obtaining a re-rating. And this will further improve our liquidity and visibility to institutional investors. So this access to the sponsors' strong pipeline is very, very fundamental to this transformation. Our unit holders are aware we have earlier on done a similar strategy for ALOG, rebranding it and growing ALOG in the last 18 months. And moving forward, it is quite a similar strategy. We're actually transforming both REITs into a new APAC REIT, which has access to the best-in-class assets and comprising of new economy assets. So I would say that this is really a very transformational transaction.
Thanks, Karen. So scale, size, sector, sponsorship, in sum, it is a transformational merger that brings about the situation where size does really matter.
This value creation that Karen and I has mentioned, it's not only just limited to the DPU accretion that we have put out in the public, 5.8% DPU accretion for ESR-REIT, 8.2% for ARA or trust shareholders. The value creation just go beyond this. Now, people also need to look at the risk part. What is the inherent risk today in Singapore portfolio assets? Both of us are still quite entrenched in Singapore industrial. We still have quite a fair bit of Singapore industrial assets. And the fundamental issue with Singapore industrial assets is land lease. In the industrial sector, we all have land leases of only 20 to 40 years. Increasingly, JTC are only giving out land leases of 30 years. So the land lease decay is a risk problem in the industrial. It's a key risk. But what this merger allows us is that because of the larger scale, because the ability to be in the right sector, because of the sponsors pipeline of 50 billion that we mentioned, right? And these sponsors pipeline assets are in regional, and they are freehold and longer dated land lease assets. We are able then to address the underlying land lease issue. So your land lease decay become less of a risk factor to our portfolio, which means that equity investors will then require less of a premium, equity premium in our dividend use for our assets. And this will have a positive effect, potential positive effect on the share prices. So this merger not only addresses the upside, the returns, but it also reduces the downside risk.
Now let's go on to some of the challenges, Karen and Adrian. There have been some feedback from the unit holders, especially from ALOG, that the deal doesn't seem to be as great as for the ESR-REIT unit holders. So maybe I can hear from you, Karen. Is it a bad deal? Is it a good deal?
When ESR-REIT approached ALOG for this proposed merger, Adrian and I had many discussions, and we considered the terms carefully. So first of all, this transaction is a merger. It's not an acquisition. Our ALOG unit holders are not selling out, but rather they are rolling over to a larger REIT. So we then reviewed the rationale and the benefits that this transaction will bring to our ALOG unit holders. ALOG can take advantage of this paradigm shift opportunity to scale up faster versus what each REIT, currently both smaller, can do on its own. So we really want to clarify that this is not a sale of ALOG, but rather is a merger of the REITs, bringing along its best-in-class attributes, such as combining talents from both teams to focus on growing the new REITs. So I'm also aware of comments such as, offer price premium being close to last closing price of ALOG just before the merger was announced. But what I want to highlight here is that ALOG's unit price has surged about 48% year to date. And this is a reflection of the positive attributes that the market has priced in. So as such, the offer price of 95 cents has already taken into consideration these positive attributes that will be brought into the enlarged ALOG. So the existing allows ALOG unit holders to roll over into the enlarged REIT and participate in further upside based on the enhanced growth trajectory while crystallizing their shareholder returns. So furthermore, this merger is DPU accretive to ALOG unit holders at 8.2%. So we think it is fair, and looking beyond the shorter term, the merger will supercharge our growth going forward as the enlarged REIT, as we will have access to over 50 billion of new economy pipeline. So we believe this is a good opportunity, and hence putting forth this deal to our ALOG unit holders for consideration.
Can unit holders look forward to a better deal?
Like what I've articulated earlier on, the pricing has already reflected the positive attributes that the market has priced in. And we think it is fair. And in fact, the DPU accretion of 8.2% is one of the highest among all the S-REITs precedent mergers. And there's also a NAV accretion of 2.2% for ALOG unit holders. On this consideration and considering the upside that the merger is going to bring about, and this has not been priced in. So hence, at this point in time, we think that this offer is a fair one for our ALOG unit holders.
The share price of ALOG has surged 50%. We have also surged. We surged about 25% year to date as well. But obviously, ALOG has surged more. Why? Because of the pure play nature of logistics. The tailwind behind the logistics sector is bigger than the tailwind behind the industrial sector. So we are not paying for something that is unit market investors has not reflected. The fact that the 50% is a price in so-called offer price that we actually put in, reflecting all these attributes, positive attributes, and underlying economic fundamentals. But the point is we're trying to say is after you have this, you come together as a larger, we are able to then do more and has more potential upside. So when I explain the upside to unit holders, my own unit holders, they understand, okay, I know where you're saying from. It's not unfair because the fact that, yes, you are basically paying what is priced in by the market, and that with your explanation of all the potential upside, the right, continue with the right sector, continue with the pipeline, my unit holders say, okay, I agree what you're saying, and yes, I think it's a fair price, that fair transaction exchange ratio that you are talking about.
Transformational merger where size does matter, the transaction where the financials make sense, is fair, and there's upside. Can REIT holders afford to not do anything? Karen, can ALOG REIT holders say, let's just sit down and do nothing?
This transaction, eventually we will have to put forth to the unit holders, and they have to make that decision. But like what we have been discussing since the start of this conversation, Adrian has given an overview of what is the paradigm shift in the market, in the world that we are seeing right now. And the pandemic has actually hastened this shift. And by combining together, we are actually more well positioned to take advantage of this disruption. And both our combined portfolio of logistics and high specs properties are suitable for a lot of these new economy users, such as data centers, advanced manufacturers. So the investors are progressively allocating capital to these new economies. I would say that now we have this unique window of opportunity for both the unit holders to come in and take advantage of this enlarged platform and grow together with us. The transaction itself is overall accretive to both our unit holders. So I think by doing nothing, we will miss out on a lot of opportunities.
And Adrian, can ESR-REIT unit holders afford to do nothing?
As you'll be aware, the ESR Cayman shareholders has already approved the
acquisition
of ARA, so it's just pending completion. They have also publicly stated, especially on 15 October when we have the press conferences, we have analyst briefing, that ESR-LOGOS REIT going forward will be the sponsor's flagship new economy APAC REIT. ESR Cayman ultimately is still a listed company, and they have to utilize its resources wisely. Now, this is a once-in-a-generation opportunity for the enlarged ESR group, and as well as ELOG will be merged together to ride this disruption and be dominant in APAC. Now, in addition, with a larger scale in comparison to each of us pursuing our own growth independently itself. And Karen has mentioned, we even before we merge, we are already able to get very competitive costs. And just if I put numbers in place, we are getting a 2.25% loan that is 4.5 years, fully unsecured, to refinance ALOG's existing loans of about $800 million as of 30th of June. That is at the average debt cost of 2.94% and about 3 years remaining. So we're getting cheaper, longer, and then unencumbering all the assets. So this is already a taste of what the access to capital and the funding cost, cheaper funding cost that we have already been able to deliver. And this is just before the merger. Yeah.
So unit holders, to sum it so far, the story behind the merger, it is transformational, where size does matter. That's a great story to tell. There's upside to it. It is all fair. It's exciting. Now let's look at the future in our last segment for this morning, Adrian and Karen. You talk about the 50 billion pipeline from the sponsor and 10 billion in development pipeline. What next
First and foremost, we will work very, very closely to develop a detailed strategy plan for the enlarged REIT once we complete the transaction. So with this enlarged scale, we immediately become one of the top 10 S-REITs by free float. It positions us well to attract more institutional investors, which should further drive liquidity and lead to a potential re-rating, and that's important for us. So we will be able to access a wider pool of capital and more competitive cost of debt. And the combined REIT will form the new benchmark new economy APAC S-REIT and will be a flagship REIT for ESR Group. And we will have access to the sponsors over 50 billion pipeline. And this places us in an even stronger position to supercharge our growth. We should expect to see some potential upside from economies of scale when we procure services, which will bring down our operational costs. We can offer more leasing options to tenants with wider pool of assets at more competitive rents. And this would enhance tenant stickiness to us. And where we will be able to leverage the enlarged group's existing marketing, leasing, and asset management platform to enjoy other economies of scale across the operations.
What will be a more indicative milestone, Karen? First quarter, second quarter, third quarter, fourth quarter, 2022. Anything specific that you can share with unit holders and tenants that will excite them in the future post-merger?
I think we have given ourselves, Adrian, we have given ourselves possibly the next 12 to 24 months to do several things. One is, of course, the acquisition of the immediate visible and executable pipeline of about 2 billion. The second thing is, I think we discussed a little bit on how we are going to address some of the gaps in our respective portfolios, such as the short land lease that both our portfolios have. So how do we do that? We may look at possibly, lease extensions, and this will entail discussions with the authorities. And we could also look at possibly repositioning some of these assets to see if we can secure lease extensions or not. And we may also look at opportunities to, select those non-core assets and divest them so that we rebalance out the portfolio and recycle the capital to fund our acquisitions moving forward.
In short, Karen mentioned we have a time frame of 12 to 24 months. We will want to do it faster, but I think 12 to 24 months is a fair thing. The focus on us is immediately, the focus on is the acquisitions. Then we look at the internal our portfolio, non-core assets, those assets as short land leases. We have to address this. The faster we address, the better it is. The portfolio becomes less risky. And the third milestone, because you look at our capital structure after the merger, we have closer to about $2.4 billion of debt, as a large vehicle. It's good that we have competitive terms. It's good that we have unsecured assets, but we want to do more. One of the key areas which we have gotten feedback from our, at least ESR-REIT shareholders is, hey, Adrian, you're going to be a big boy, 5.4B. You have looked at your growth plans, you're very excited, you have to come to the market more for not just loans, bonds, but equity, But they're telling us, why don't you go and do a credit rating on the trust? Because the credit rating for the trust will allow a lot of these bond investors to actually deploy a larger pool into, because you are rated paper. And this will help to bring our bonds and our cost of and access even further down with a rated property. Most like in all credit markets, right? A higher rated company issuing bonds obviously is cheaper than a non-rated company because of risk. And also at the same time, being rated as a trust also serves as an improved corporate governance.
Thank you, Adrian. Great milestones, and I would say great speed to market. That's another S for you, speed to market. So you have a great story in the right sector. There's solid fundamentals in terms of the financials, and excellent story. So with that, maybe at this stage, Adrian and Karen, can we hear your summary as to the merger?
I guess in conclusion, as you can see, both Karen and I are very, very excited at the prospects of the enlarged ESR-LOGOS REIT, or ELOG in short. Number one, we are in the right sector, right time. This is a sector that has shown resilience and has the tailwind behind us. The way goods are produced, delivered, and consumed has changed. This COVID-19 endemic now has exacerbated this paradigm shift towards this new economy assets. And we are actually in the midst of the largest secular growth of trend in actually APAC. Number two, we are well positioned to tap the flows of capital to a few sizable players. Merging the two best-in-class assets of ALOG and ESR-REIT with proven track record to become a sizable and liquid REIT makes a lot of business sense. Together as an enlarged REIT, we can actually capitalize on these capital inflows to grow our portfolio. Now, third, we have the ability to tap on the sponsors' resources and acquire our sponsors' pipeline of in-demand and increasingly scarce assets. This merger will focus an already aligned sponsor, ESR Cayman's financial resources, asset pipeline, and tenants to actually supercharge our ELOG's growth. Now, for the REIT, enlarged REIT with a combined asset base of more than 5 billion, we are actually in a better position to do things faster as well as larger, to not only give the returns, but at the same time address fundamental issues that we have in the portfolio, which essentially is short-term land leases. That's why this merger to us actually makes a lot of sense.
Thanks, Adrian, for that concluding remarks. And over to you, Karen, your thoughts?
Likewise, I'm very excited to continue this growth journey in the enlarged REIT as the Deputy CEO, working alongside with Adrian. So we believe that this merger will create value to both our unit holders beyond just the immediate DPU accretion. So I would like to reiterate that our ALOG unit holders are not selling out, but rather rolling over to an enlarged platform. So in addition to that, we have received an irrevocable undertaking from Ivanhoe Cambridge, one of the largest institutional fund manager in Canada, who also currently owns about 8.74% of ALOG, to vote in favor of the transaction. So this is a clear testament of their confidence in the enlarged REIT's long-term growth potential. So both ALOG and ESR-REIT, once combined, will be well positioned to take advantage of the largest secular growth in APAC and the many benefits that Adrian has just articulated. So in view of these benefits and rationales, both Adrian and I have been sharing so far, we believe that our unit holders would support this merger and continue this growth journey with us. Thanks, Uantchern.
Thank you very much, Karen. And if I can summarize on behalf of Adrian and Karen, it is a transformational merger where size really matters. You're in the right sector, which is a new economy. In the scale of the merger will result in a $5 billion enlarged asset base. And in terms of speed to market, there's a $2 billion immediately in the pipeline for execution. And you have great milestones that you just mentioned, Adrian, just now.
Yes.
So it is a wonderful story. And with that, I hope that unit holders will look forward to the dialogue session that SIAS will be holding. Look out for the date, and we look forward to seeing you there soon. And with that, let me thank Adrian, ESR-REIT, and Karen, CEO ALOG, for their time this morning.
Yes.
Thank you.
Thank you, Uantchern.
Thank you very much, Adrian. Thanks, Uantchern. Appreciate it. Thanks.
Thank you, everyone.